Ladies and gentlemen of this audience, my respected professional colleagues, and esteemed members of the corporate sector who are here with us today. My first is I'm grateful for this opportunity to facilitate this session on due diligence on the restructuring environment. And I can start off with compliments to the team. I think this is an excellent seminar which has been put together in this world of today where there's so much disruption we see. We see disruption in the political sector, where we have a lot of political reconfigurations happening in India as well as in the world. We have disruptions in the social sector, with social re-engineering being the new term which is happening. And we have disruptions in the corporate sector, with corporate restructuring. And corporate restructuring has various forms. We have restructuring, re-engineering, refitting, downsizing, right-sizing, and those are the terms used for corporate restructuring. So in this disrupted world, it therefore becomes all that more important that we exercise a degree of care and diligence in all that we do. The corporate sector looks upon us as professionals to provide that guidance and inputs so that one treads carefully and with confidence as one goes through this disruptive work. As the chairman of Unilever put it a couple of years ago in the address at the AGM, this is a VUCA word, a VUCA word, which is volatile, uncertain, quite problematic, and upheavals are significant in this world today. So with that degree, with that degree of confidence, may I try and address this issue of restructuring. What we shall talk about today is what is diligence, due diligence or financial due diligence. How does it fit in a corporate restructuring environment? Some elements or issues which we need to be careful about when one carries out the process of due diligence. And predominantly we'll discuss the focus areas one needs to focus on when carrying on the due diligence. So what is due diligence in this environment of corporate restructuring? It is to provide, it's an informative investigation, it's a form of a detailed review where into the business of the company, into the company's operations, as well as the environment in which the company operates, so that both the stakeholders are, be it the company, the lender, or the shareholders, are able to take an informed decision on the next steps of how to revive that company. And that is the objective, fundamentally, of due diligence. So we know that there are various forms of restructuring which can happen in terms of revitalizing a company, in ensuring that the value of a company is then captured and re-brought up or resurfaced because of a proper restructuring. So what are the various forms we know? One is, of course, that the company is sold to another potential buyer who is able to exploit the benefits of the company better. The other way is to carve out some of the businesses of the company which are not part of the core business, or where value could be encashed at this point of time, so the business is acquired from a company. It is possible that the company requires a bit of financial investment to take it to the next level, and that's where you have private equity or a strategic investor. And fourth, you could have something in the same, all these elements in a cross-border situation, where an overseas investor coming in to acquire and provide support to the company. These are the various forms. And you have different stakeholders, depending on who is looking at it. They all tend to look at or prioritize a different area of focus. It may look different, but at the end of the day, if you look at it below the surface, there's a degree of commonality between the key concerns a private equity investor would have, a strategic investor would have, and a lender would have. A strategic investor is keen to look at the cash flows, the quality of earnings, and is looking at the value. And as soon as he's investing, he's also looking at his exit strategy. He's also able to be very keen on the forecast profitability and cash flows of the company in the near future. A corporate client, on the other side, who's looking to acquire the business, He is also keen to understand, apart from the value of the company, the potential synergies, how we could try and integrate the business and exploit the benefits where the whole is better than the sum of its parts. And some of the impact it might have on his own tax code, on his tax impact, the tax impact of the corporate client as well as the company being acquired could be different. And those to try and realign them is a challenge which the corporate company will be careful about. Whereas a lender has 5 different areas of priority. First, of course, as you see, is the importance of generation of adequate cash flows. Are they sustainable earnings? Second, what is the break-even point of this business? So that are there adequate margins to cover the fixed costs and leaving some money left for the business to repay its lenders? Related party transactions are important not just from a tax point of view because of your transfer regulations, but also from a business point of view to try and understand are these at a fair, demonstrable arm's length. Fourth, what is the level of working capital the business requires? And what is the level of financing the company requires to maintain that level of working capital? And finally, fifth, what is the level of debt that the business can sustain, the business can then repay over a fair period of time. And these 5 elements become very crucial, even from a diligence point of view, to focus in a restructuring environment. Therefore, what are the objectives or the benefits of the diligence? What should we be focusing on when we try and look at a diligence in a restructuring environment? You try and find out what is the underlying value of the business or the company, but also find out what the black hole is. Everybody's concerned, what's the level of debt, what's the level of liability which is left in the company, which needs to be paid out. The elements which you need to be focused on is to try and understand a fair understanding of the business and understand what the values of the business are, what are the potential benefits as well as the downsides, what are the issues which could potentially threaten the transaction, so try and address and find solutions before the deal is coupled. Fourth, how do we value the transaction? What are the value drivers? Fifth, it could be points of negotiation in the transaction documents in terms of condition precedents, in terms of certain compliance which are to be carried out before the transaction is put through. And finally, there could be certain issues which need to be resolved post the transaction. After the business is restructured, there may be certain elements which need to be addressed post that. And is that being addressed carefully? Are they identified so that they are addressed in a timely manner? Due diligence tries to identify all these elements during the course of the exercise. Due diligence has evolved over a period of time, but I think the basic concept that buyers beware remains, more so in a restructuring environment where the buyers need to be doubly beware before they get into acquiring an asset which is restructured. You want to be very cautious that the assets are at its value which they are stated, and that there are no liabilities over and above what is stated. So therefore, it's important that diligence continues. So the concept of buyers beware is an important underlying principle when one carries out due diligence in a restructuring environment. So what are the various stakeholders when one looks at a transaction, particularly again in a restructuring environment? You have the business which politically incorrect but perhaps now commonly used across the environment it's called the target. The target is the company or the business which needs to be restructured, and therefore you have the seller, who is the company or the promoters of the company, who would be the ones who are willing to sell the business. It could be a sale or it could be in a business which requires further investment. You have interim advisors, including the investment advisor, the M&A advisor, it could be the tax advisor, to the seller to try and facilitate a transaction of this nature. And as we discussed earlier, the various forms of transaction, it could be the acquisition of the business, acquisition of the company, or investment of funds into the company. So depending on that, it depends on who would be the final investor. It could be a strategic investor who buys the business and integrates with this business. It could be a financial investor who is willing to put funds into the business for the short term. Or third, it could be a lender who is willing to lend and facilitate the working capital management of the business before it's taken on. Today we will focus on financial diligence, but one must be mindful that there are, in this session, sorry, that there are various other elements of diligence which have to be addressed. I know that we'll have talked about tax diligence yesterday. Sharad has taken us to legal diligence and some of the elements today morning, and what we will focus on are the financial diligence elements. At the end of the day, all this together, the idea, like we said earlier, was to help whoever is the ultimate investor make a fairly informed decision of the value of the company and where the platform is. So what is due diligence in a restructuring environment? In a restructuring environment, as we may know, there are three elements which happens in a restructuring environment. The company is going through a bit of stress, or it's going through a bit of refresh, and therefore there will be various elements of performance improvement which are going on in the company. That's one stream of work which goes on in a corporate restructuring. The second, if the restructuring is because of some stress in working capital or some stress in cash flows, or the stress is predominantly financial nature, then you have a lot of short-term solutions being triggered to stop the bleeding, just to ensure that the business revives and the bleeding stops. So that's the second stream of activity which is concentrated on. And third, as the stress gets first, the company then goes into various forms of financial restructuring, including hire off of businesses, hire off of investments, sale of assets, required so that there's adequate cash flows coming in so as to then revive the company. So these three streams of work continue. And in this form, during this time is when diligence comes in. Because during this time when the company moves, and we see in the Indian corporate sector particularly, an Indian company which is very healthy can suddenly turn insolvent or suddenly turn to being stressed quite quickly. Just the other day you might read that it's a dividend paying company and the market share has zoomed, and the other next day you might see that there's a crash. In fact, one gets very wary when the prices go up of a company which is not in line with the rest of the market, that there is something untoward perhaps in that business's share. So when the crash comes quite suddenly. And therefore, during that interim period when it's healthy to the time when it's in stress, is when various forms of restructuring of the company takes place. And it's that time in the middle where you see that is when diligence pays the most value add to the transaction process. Diligence at the end of the day again is to facilitate the transaction, is to facilitate the revival, is to facilitate the re-engineering and restructuring the business so that the underlying value of the business is once again encashed and realized by all the stakeholders, the shareholders, the lenders, and the employees. So that's the element, that's where diligence in environment comes up. It is a complex environment, as you will see, given the various streams of work over and above the operations. The company's management has to go through. There's a lot of focus, a lot of elements which is drawing the attention of management apart from the operations. So our focus of the management is sometimes diverted towards elements such as this restructuring. And on top of that, if you want to try and get a due diligence exercise carried out, if you are the due diligence provider, one has to be very conscious about trying to be very pragmatic, trying to be very solution oriented, not more as an interference into the process and the underlying true nature of the business, which is to run and make money, so as to ensure that the focus of the promoters of the company continues on the business and try and find solutions to the whole situation rather than be an additional problem or hindrance. So when these three streams of work, performance improvement, short-term solutions, financial restructuring are going on, it is important that whoever is the diligence provider is integrated with all these streams of work and remains conscious of what he's supposed to be doing. So that's the value proposition is clear. In diligence must be understanding of what the corporate needs are at that point of time. It could be additional cash, it could be a sale of a business, it could be sale of shares, or an infusion of funds. It could be infusion of equity funds or equity or infusion of debt funds. And depending on that understanding, the solution arrives and the opportunity provides for the lender or investor. And the lender or investor is looking at either refinancing in a bit of a distressed situation. The lender is trying to be very cautious and ensure that his cash flow is protected and his repayment is protected and he's adequately securitized and he has some control over the finances and the cash flows of the company. And therefore the solution is therefore to ensure that you have a very focused diligence. One has to be very mindful that You don't look into areas or other issues which are of not importance, but adequate focus is paid to those areas of importance, to the company and to the stakeholders. And then use of experienced professionals so as to ensure that you have a value-added solution rather than just a process. So that's the environment of diligence. So what is the process? The process of diligence doesn't change fundamentally in a restructuring environment as compared to a diligence in, say, an M&A environment or any other form of diligence. These steps are quite structured, and today in the economic and corporate world, there's quite a bit of realization, understanding of the process. The beginning is, of course, to define the scope of work. And the scope of work is defined with whoever is asking for the diligence. It could be the lender, it could be the company itself who's acquiring the business or acquiring the company. It can also be the company who's selling. Today, the concept of vendor due diligence has taken shape in India, and there is a high degree of acceptance in India of vendor diligence. A vendor due diligence, of course, when the seller instructs an independent firm to carry out the diligence, and that report is provided to potential buyers, and then reliance is placed by the final buyer or the final investor into the company. So the terms of reference are important, so the areas of focus are clearly laid out. Then the use of information request lists, so the company collates the information required, the fieldwork is carried out, there's continuous dialogue between the target, the management, your client, as well as yourself. You identify the issues, obtain responses from the management, and then you present your findings to the ultimate investor. And that is the due diligence process. And then the issue of report is finally there. In terms of process, what the process issues are, one has to be mindful of the quality of information. As we said, it's possible that this could be in a stress situation. So in a stress situation, the company may actually have challenges of trying to give you the information which you require. So the quality of information, and this is where, in fact, whoever is a conscientious diligence provider would actually work with the management to try and find solutions of how that information could be collated. The underlying principle should be no new information should be created. If it's information which management has not looked at till today, it's not meaningful. It should be information which management looks at on a regular basis to supervise the business. It could be in any form of MIS. It's not necessary that the MIS has to be of the highest form. It could be in whatever day-to-day form management looks at. That is the most relevant, that is the most meaningful. With that you know you're looking at the same information management is to run the business. And if the company has challenges of trying to get you information in a particular manner, it is a responsibility of the due diligence provider to work with management to find solutions to get the information required in any other manner that the company is able to do it. Unlike an audit, in an audit, it is statutorily laid down on the extent of information which you require. It's statutorily laid down on the extent of disclosure you need to make in your annual financial statement. So because of those statutory requirements, there's a minimum level of information you must mandate the company, and the company is mandated to keep and to provide the auditor. Similarly in tax, there's a minimum level of information which you're required to comply with and fill in your tax return for the tax audit. But a diligence, let us be mindful, is fundamentally a business-oriented exercise. The scope of work is not laid down in law. The scope of work is as agreed with the person investing in the company and the diligence provider. So in that sort of situation, it's very clear as to what the information will be made available and what are the ways around to try and find the information which is critical. All parties are conscious that there is a minimum level of information required, so whoever is the investor has a fair understanding of the business and of the company. And that could be in any form. It's not necessarily it has to be in a structured, laid out, mandated form. It could be any other form the company is able to provide. So that's first critical element of information which is important, a key issue of focus. If you get your information right, if the flow of information is clear, the target management is satisfied that it's easy to comply with, then you're able to start due diligence quite easily. Otherwise, you have a lot of issues right up front, a lot of concerns, a lot of challenges, a lot of pushback, and a lot of irritation which then doesn't facilitate the process of constructive due diligence. The second key important thing is the kind of resources one puts in, the kind of people. And there is a challenge today. There are 5 key elements you must look for people who are actually performing the diligence. The first is you must have a clear, sound commercial understanding. The second, apart from sound and commercial understanding, is the ability to quickly get to the business issues of the company, a quick understanding of the business issues of the company. Third, one must have clear communication skills. Must be very clear on what you're asking for. The verbal and written communication, it has to be a minimum level, which target understands. And which brings us to the fourth point, which is critical. Because India, in a way, is a mini Europe. With every state, it's got its own language and culture. So importance is very critical of understanding of the local language. If you send someone from Delhi down to Tamil Nadu or to Chennai to try and get a diligence done, it will never happen. You send someone from Bombay to Delhi, the person from Delhi is going to take the person for a ride. He's going to say, all information is ready, Delhi aa gaye, sab ho jayega. Poor fellow will be sitting there for 2 weeks and waiting for information. He comes to Chennai, he says, the Chennai person will say, I'm so sorry, I was to give it to you yesterday, I'm giving it to you today morning. And you go to a Bombay person, I'll meet you in the morning. If you turn up in the afternoon, the person in Bombay is going to get extremely uncomfortable. But this is quite common in some parts of the country. I'll meet you tomorrow. Tomorrow could be any time during the day. It's only in Bombay where we are driven by the clock. In other parts of the country, they know the value of time, perhaps in a different way. So it's important that someone who has local expertise, local understanding, understands the local language, is able to then share the information with you. So apart from good talk, sound commercial knowledge, a quick understanding of the business, communication skills, local language, the fifth, perhaps most important, is stamina. And I don't just mean the ability to do it, but the inclination to do diligence. Diligence, there are no quick fixes. It is actually tougher than a marathon. It is for the long haul. It requires an extended, tremendous amount of patience, because it is possible that the target management is not very comfortable seeing. Many a time I've gone the very first day. The first question I'm asked is, when are you leaving? How long will